Okay, hello, you trader nerds. Welcome in. And I think Tony from Mexico as TFM is in the building. Hey, Tony.
Hey, Bobby, thank you for the invitation.
Oh, thanks for coming back. You really got us all upset last time you were here, Tony. It's like
I'm
you just
sorry. I felt bad. I messed up your Zoom call, your group. I hope they don't hate me.
no, we actually love you for coming in and going, hey, you might want to consider a little bit of protection. So that was a really good thing. And, it got me to thinking, I don't even know why we abandoned the Black Swan hedge to begin with. And I think it had to do something with we diagonalized it and it was messing our Greeks up or something. But
Right,
uh,
right.
there's no reason not to have it, especially if we do it the way that Ron intended it to be as a
Right.
free hedge. Why not do it?
You know, the last time we spoke, I felt bad because I just uh, mentioned the illness, didn't mention the cure, or vaguely mentioned the cure, and this I'm a person who's more focused on the risk than the reward. And I think it's very important to focus on the risk part. That's why I'm very focused on planned capital and how much capital the 112 is going to suck from our accounts if the S hits the fan. And another way to prevent that, if you don't want to do the Black Swan hedge, is to be very, very strict with taking losses at a 2x loss. If people are very, very diligent and they're very good at taking losses, then that's another way to protect your account, because the amount of capital that these trade will require if the VIX goes to 30, 40 and the puts go near at the money, it's going to be very, very big.
And so you did some work. You sent me a little graph and everything that you kind of did some work, kind of showing us how all this kind of fits together.
I did. I don't know if you have it there.
I don't have it here, but do you have it on your screen? Can you share it or?
Oh, I should have it. I should have it. Let me see. Yes, sir, I have it. If you can make me the host, the hero of this, I can share it.
Yep, let me make you the host.
Yeah.
All right, you are the host.
Oh my goodness, I'm so excited.
We're all excited.
All righty, so here we are.
Yep.
So this is what I called planned capital.
Mm-hmm.
Planned capital is what happens if the S hits the fan. See? And how much money does an ES contract? I don't know if you can see that my account size, I'm pretending it's $1 million.
Yep.
Right? And this is all based on the 112. This is I did a little simulations with a couple of friends of mine who are really, really smart. And on the top, I mentioned how many units we're going to do every month. What's the planned profit per unit? A percentage of those units will end up in the trap. That's the 3,600. And how many times a month? Sorry, some things are in Spanish, so twice a month. And then what we figured out here is if we take the loss at 2x, you see the red number, the 2,200?
Yes.
That will prevent some major bleeding, major damage. And after all the analysis, because the Black Swan hedge will probably prevent us from getting a margin call. But in order to prevent a big drawdown in our accounts, which is everybody wants to prevent a big drawdown, taking losses at a 2x, at a 2x, which, if you take $1,000 credit, we take a $2,200 loss. That could help us avoid a potential maximum loss that you see down there of $105,000. So, wow. So we did a lot of what do you call it, Monte Carlo simulations. Mm-hmm. Thank God, I have very smart friends who are mathematicians, and you could blow, easily your 10% of your account if you are not diligent taking losses. So that is my comment. So it's important to do the Black Swan hedge. It's important to take the 2x loss, and it's important to know how much margin. If we let me put here in yellow. Tell me if it turns yellow.
Yes.
So it's turning yellow. I want to note what the different margin required on SPY, on SPX, etc. at a 5 delta. If you see SPX at a 5 delta only takes out $37,000. But at a 70 delta or at the money, it grows teeth
Absolutely.
to $90,000. Now, the advantage, same thing with SPY. The advantage of trading futures is the margin in the future explodes, but not as much as it explodes on SPX. So another way to have a little bit more protection is the way you're doing it, is trading more ESs and MESs instead of SPY and SPX.
Mm-hmm.
Because when the VIX explodes and when margin explodes, the explosion on SPY and SPX is humongous. So, and this is in regular margin, and the bottom is on portfolio margin. You see in portfolio margin, I'm gonna maybe do a little light blue. So portfolio margin is, you can see the SPX, instead of 37,000, it goes to 9,000 to do a 112. And if it goes at 70 delta or at the money, it explodes to 67,000, which is, almost 7 times, So whatever you think your capital is on SPX, it could really, really explode on you if the market crashes down. And if you do it on ES, I think it's a little bit more manageable. But any case, everybody has to keep, you know how to do it, how the Fed asked the banks to do a stress test on your portfolio?
Mm-hmm.
This is a stress test on our 112 portfolios. If you really want to know how much money you are risking, I would take every ES put and multiply it by 14,600 if you have portfolio margin. And portfolio margin and regular margin is the same. And if you have SPX, I would take 67,000 for portfolio margin and 91,000 on regular margin, which is a big jump.
So
right?
Is that the margin for selling the one put or the 2 puts of a 112?
This is one.
Okay, one.
Let me put it here. One. Let me make this red. One. Just one. Unfortunately, it's just one.
Yeah, I would love it to be better if it were 2, right?
Yeah, me too. Yeah, we all wish. But I also wish I was 5 feet taller and I had more hair. Maybe 30 less pounds. But you see, right now, people have been spoiled, except for the 3 weeks of COVID. They've never experienced a big down move,
right?
Especially the young guys. And I have lived through the good times and the bad times. And I don't want to be negative Nancy or anything like that. But if you trade long enough, the tails of the distribution of the probability, the curve, you will experience them sooner or later in your career, right? So in order to survive the tsunami when that happens, we don't know when that is going to happen. We have to at least know how much we're risking. That would be our planned capital. For example, I don't know if you do you have any portfolio available that you can tell me how many ES contracts you have open?
Yeah. Keep talking and I'll find it. Let's see.
Yeah. So and then I'm gonna ask you to tell me what is the buying power required for those units.
Okay, so in one of these accounts, I have 20 naked puts of
ES.
Yes.
And what is the computer telling you? How much margin is it sucking up?
The margin for all of these is positions. Let me make sure I'm in the right account. And the margin for those is 67,000.
All right. So let's divide 67,000 divided by 20. So it's sucking up $3,350, which is what I put in my
Yeah.
right here.
Yeah, very good.
Okay. So what happens if the crap hits the fan?
Mm-hmm.
It's going to go to 14,600. So if we multiply 20 times 14,600, it's going to take us to $292,000.
Okay.
That doesn't mean it's going to happen. Hey, I might die, my kids might die, and maybe it never happens, right?
Right.
It's like when you have fire insurance. You have it, but you don't want to have a fire, right? But I want you to at least be prepared in your mind that that is the margin that's going to be required if something bad happens. 292,000. But like the TV commercials say, wait, there's more. And this is the last part of my negativity.
Okay.
So what do you think happens when the market goes down with one of these trades? Does your P&L go up or down?
P&L goes down.
Down. So besides the 292,000, think of maybe taking another 10, 15% or 20% drawdown on your net lick.
Mm-hmm.
That will, so you have two factors working against you. The reduction of your net lick based on unrealized losses and the increase in margin because of the increase on the deltas. So it's actually a perfect storm, a double whammy. So this, I'm guessing the margin could go to 350, 370,000. And, you know, I don't want you to change anything. I just want people to know that it could happen, that it might never happen, but just be conscious that if it happens, that's the effect. That's the bad thing that's going to happen.
And so the thing that we've got to do is have a plan in place for if and when that does happen.
Right. And like we buy insurance for our houses, we buy insurance for our cars, and I think we should buy insurance for our portfolios. The Black Swan hedge could be a very good insurance. The other insurance is, for example, if there's a fire in the house, you can walk out of the house, right? And not stay inside the house. So if you walk out of the house while the fire is going, that's like taking losses on a 2x basis. So I hate taking losses. I'm probably more than anyone on this group chat that we have. But sometimes a small loss will help us survive this thing.
And by taking those losses, it keeps us in the game.
Exactly.
We don't have to do it that often. It's horrible, but you'll probably make that loss up in the next, 3 or 4 trades.
Yes. Have you heard of the finite game and the infinite game?
No.
So I'm a Raider fan. I'm sorry. I've been the Raider fan since I was 5 years old, although we got our day in the sun yesterday. But the NFL is a finite game. A finite game has established rules. It has established players, and you have winners and you have losers, right? And everybody knows the rules of the game. That's a finite game. An infinite game is a game that never ends. Players come in, come out. The rules are not, they're flexible. They change all the time. The players change all the time, and there are no winners and there are no losers. In an infinite game, the person who wins is the person that stays in the game. And I want everybody to think of trading as an infinite game. If we play trading as a finite game, we either are going to win or we're going to lose. And in trading, the key is to stay in the game. And in order to stay in the game, what's important is not to blow up our accounts, right? Yeah. So if we want to play the infinite game, because the market really doesn't care, the NFL cares if the Raiders win the game or the Chargers win the game. But the game we're playing, which is an infinite game, Mr. SPX doesn't give a crap if I drop off and somebody else joins, and then you drop off and somebody else joins. And if they raise the margin requirements or they reduce the margin requirements, it's an infinite game. It's always going to be there. the rules are going to be changing, the players are going to be changing, but the people that are going to succeed in an infinite game are the people that stay in the game. So the reason I gave my comment last time is because I look at investing and trading as an infinite game, and I want everybody here to stay in the game. And I think that's very important way of looking at things. And it's just a different mindset. And of course, trust me, I'm smart enough to understand that if you look at it the way I'm looking at it, you're going to place a smaller size, and your return on capital is also going to be smaller, right? But you can stay with your same size and try to achieve the return you're looking for, as long as you are very strict and taking losses. The Black Swan hedge will prevent you from blowing up the account, but it won't prevent the losses. Because by the time the Black Swan hedge kicks in, you're probably down 20-30% on your account. So the only way to prevent a big drawdown is by taking, in all the Monte Carlo simulations we made, is by taking the 2x loss. So I would do two things: do the Black Swan hedge and be very strict with the 2x loss, and then you can play the game and be aggressive and try to achieve your desired return on capital, and then everybody's happy. So that's like a summary of what I've been thinking since the last time we chatted.
I love it. And on the 2x loss, I guess you could do it a 2x loss on the entire trade, or you could do it 2x on just the naked portion. I guess you could do that either way.
Yeah, yeah, of course. I like doing it. If I always like to leave. Well, there's a saying in Spanish. I like to leave the party with the person I came. So normally, if I came in as a 1-1-2, I like to leave as a 1-1-2. If we have to take the loss, maybe that's profit on the long put vertical is going to help us stay in the trade a little longer. Right?
Yeah, because that's Herb's question. Would you take the 2x loss on the two naked puts and leave the debit spread in place?
Right. If I were, like I said, I like to go into the party together and leave together. So I would take everything off at the same time. And you know why it's good to take it off? Get that crappy trade off your books and then redeploy.
Right.
At a much better location. It's like we all love football, right? So let's say we're stuck at the 1 yard line and it's 3rd and 10, and
or it's 4th and 31 as it was in Alabama
31.
Game.
Yeah, I'd rather reset at the 20 yard line and have a 1st and 10. So I like a reset. I like to, it's draining on your brain. It's draining on your mind to be babysitting partial trades. I think in order to be a good trader, you have to have a clear mind, like we talked last time. And by taking everything off and redeploying, that will help you have a correct mindset, I think.
Now the question is, how big does my Black Swan hedge need to be for my account? I don't know if you've done any analysis of that. In the $450,000 account, I bought what I called 4 units of the Black Swan hedge. So I sold 12 puts, and then I bought 20 puts. So 5. I did 4 of those to get the campaign started. And if we develop this thing out like the little PDF that I shared with everyone the other day, we eventually I would love to be doing 200 short puts and what is it? 1,200 short puts and 2,000 long puts.
Well,
so to build that up as much as I can.
1-to-1, you when you do a Black Swan hedge, it's a net 2, right?
Yeah.
So if you have 20 short puts on ES, the minimum I'd like to have would be 20 SPX long puts, net long puts.
Net long puts, gotcha.
And the ideal would be triple that. So it would be 60 XPX puts against 20 ES puts. then I think then the black swan hedge will work. The problem with the black swan hedge, it starts losing its power every day. So it's like the timing has to be perfect for you to have the correct black swan hedges with the correct expirations in order to help your account correctly.
Mhm.
You might have 120 net long puts, but if they're only 60 days out, they're not going to be a lot of help to you.
Right.
So I would at least hope to have triple the amount of your naked puts, and at least have them 90 days or more out
Okay.
to be powerful.
And so what I did in my trading plan, a lot of people are asking about the, let's see if I can share this. Well, hold on, let me share. Let's see. The Black Swan hedge, as Ron set it up. Come on. See if I can pull up my trading plan here. Yeah. And I will share with everybody the part of my trading plan that talks about, and what I did is I took Tony's advice too, that I didn't just go, hey, I want to, mess it up, calendarize it, whatever. I wanted to actually do it just like Ron said. So let's go to the part that talks about the Black Swan hedge.
All righty.
And so, yeah, Black Swan hedge. So what we do is, here's how Ron set it up. You sell 3 short puts for approximately $3 credit. That's what you're getting for those.
Yep.
All right. Then you buy 5 long puts that are 50 points below the shorts. Now, when he initially set this trade up, he began the entire campaign by purchasing 4 BSH tranches outright at approximately 120 days.
Right. Yep.
And ideally, you do that on a day when the market is up. But, if you need the hedge, you need the hedge, whether it's up or down. Now, subsequent tranches must be equal or greater than 60 days to expiration. Yeah. So what I did,
90. I like 90.
You like 90. I like 90. So what I did is I went out and I sold 12 for $3 at 120 days, and I bought 20. So I have 4 BSH tranches. Now, here's where the campaign goes in. Once you got your initial campaign begun, you're going to sell additional short puts on a day when the market is down 0.4% or more, or after 2 consecutive days of increasing volatility.
Right.
Now, I have built into the spreadsheet, y'all, a Black Swan hedge calculator to tell you where to buy your puts when that entire trade can be put on at a break even or a slight credit. So that's what we're trying to do. We're trying to have our cake and eat it too. And we're trying to have our insurance and be able to have our insurance for free.
Right. On Ron's group, they do another flavor of Black Swan hedge. I don't know if you're familiar with it, but they buy outright 2 delta long puts, 60 days out. And after 30 days, they close that trade down and they do it again. So that's the option number 2 for the Black Swan hedge.
So they buy 2 delta long puts at 60 days out?
Yes.
Okay. And then after 30 days,
they take the loss and use the money left over to do it again.
Okay. Interesting.
I don't know if that's easier for people, or I like the 3-5 myself. You know why? Because I always have a GTC to close out all my shorts. And I always like to have a lot of extra naked longs myself.
So then the only thing, guys, that we got to worry about, as I showed you in the PDF, if 24 days have passed and you haven't begun any additional tranches, you may have to go out and buy some outright tranches to keep your campaign going. So that's the problem, is you want this thing to keep organically sprouting up with new Black Swan hedges.
I would put that in red and highlight it, and because with this stupid market, there has been no chances to adding more Black Swan hedges.
Yeah, it's been very tough.
7 weeks in a row. So
yeah. Short put harvest. We harvest the short puts when they get to 20 cents or when they reach 14 days to expiration. And the reason why is this prevents the valley of death, right?
Yep,
From going into the
yep,
valley of death.
yep,
And
yep.
here's the important part, y'all, increase the tranche sizing when possible. So your goal is to develop a wall of, I would love to have thousands of these Black Swan 3-5
Right.
tranches in place.
Right.
So increase them when you can. So let's look at something for a second, Tony.
I like it. Hey, can you share that with Uncle Tony? Because
oh, absolutely. I'll send you I'll email this to you, Tony.
You're the professor and you're the smart trader. I'm just you're much better at writing stuff down than I am. And I love the way you really explain things. I love it. This is really, really good stuff.
Okay. Well, I will send you that PDF of that. And let me show you guys something. Let's look at the market. I said 2 days where the VIX has increased, right? I mean, I don't know if you kind of look in on this.
Yep.
Does that mean now that we've got a little bit increase yesterday? We've got a little increase today. So maybe I could sell an additional 3 puts today in that account to start my next tranche of Black Swan hedges.
You could, and it's been so dry.
Yeah,
so dry that even a little hiccup, it's now two straight up days.
Yeah. So, vol is up a little bit. I guess I could do that if I wanted to. So let's see what that looks like, guys. So everybody see this. So we'll go to ES. And Tony likes 90 days. So Ron said as long as it's 60 days or more. So we do have a 90-day here.
You know why 90? Because I want to have extra cushion, in case something bad happens.
So what you do is you go in and find one that's near $3.
Yep.
So this is the 3,300 for 315. Let's see if I can get a little more credit. And let's sell 3 of those for 320. And ta-da. So there we go. So then what's this? Let's see if the spreadsheet works. So we sold 90 days. We sold the 3,300s for 315.
Okay. I can't wait to see your spreadsheet.
Let's see if this works. So we went to 90 days. So this is going to be a BSH short. We'll call it 2. And we said, what was it? The 3,300 puts. And this is what I call short hedge. 90 days.
Yep.
12, 15, 23, and we sold it for 320. So let's go here, do ES, and we did 3. Now let's see if this thing works. So if I go to SBH break even, so I sold the 3 for 320.
Yep.
Let's see, total, let's see. It's been so long since I've used this, Tony. Let's see what this thing does. Price of harvest. Okay, so the shorts, the price of loans. That's the thing. I've got to figure out what my loans can be so that I can harvest this thing for. I gotta work on that and figure out what I need to do here. But what this thing should do is tell us how much we should sell the loans for, so that this is equal to this. So what I could do, what's this, y'all? If I set this to 20 cents, I know that's going to be my harvest, right? Okay, then let's do this. Let's do God, I can't believe I'm doing this on the fly. Let's see, dial in.
I always do 170 myself for the long puts.
Okay, and it is around 170, I think. So what you could do is say your final P&L, let's see, hold on 1 second. Let's do what if analysis, goal seek. Here we go. So set sale L2 to a value of 0 by changing F2. So by changing F2. And let's do this. Okay. And cell must contain the value. Cell by changing cell F2, change L2 by changing to a value of 0. Not sure when it's not doing that. Hold on. Anyway, that's what it's technically supposed to do. Set cell L2 to a value of 0.
This is way above my pay grade.
By changing.
You're the Excel king.
Let's see. Anyway, I don't know why it's not doing that, but you get the gist of it. But yeah, Tony's right. It's around $1.60, $1.70 something that this is, and here's how you can do it. Like, what's this? Let's pretend that we put the loan put in today. So let's just
Yep.
pretend.
Yep.
And we'll go ES, we'll go 5. And we'll call this BSH loan 2. And it will be the 3250 puts loan hedge
Yep.
in 90 days, 12, 15, 23. And then let's say, what'd you say, $1.65?
Yeah, that's good.
Okay.
Does that take into consideration commissions and the harvest?
So then we go SVH break even. So solver price of your harvest then could be, 25 cents. The price of your harvest to get that at a break even.
Yeah, you want to be safe, 160 better. Yeah.
Yeah, 160 even. Yeah. So there, you can use that to do that. So what I need to do now, guys, is go, okay, so 160, I need, and I guess Tasty, I'm not sure. I've never done a GTC order, but I think you can do GTC orders now, can't you, Tony?
I think so. I think so.
So I need to go buy
Buy 5.
5 of these, right? So I'll buy 5 of these when it can get down to 160.
Right.
Let's just change that, 160.
What?
160, and order type is here it is, time in force, good till cancel. So at 160, I'm going to buy 5 of those, and boom, chicka-lacka, boom. There we go.
Did you
And-
put 5?
Yep. And so that should be all I need to do, right? Let's make sure it's a working order. Let's see that working 5 at $1.60. Well, I didn't do 5, did I? I did 1.
That's what I
Place the order. And quantity 5.
Yep.
Oh. Why is it not letting me increase the quantity? Here, let me cancel that order. Let me go back here. We'll cancel order. Here we
You know,
go.
the futures exchanges are different than they're kind of old school. And
For 5,
5,
we
yeah.
said $1.60, so we're gonna go then there.
Yep.
And time in force is good till cancel.
GTC.
Now,
Yes, sir.
now I don't have to worry about it. Boom. So then I've got a working order there. So that's how you do it, guys, is you
Yep.
put in that GTC and you're ready to go.
I like it. I like it, Bobby.
And I guess we could do that, Tony, on harvesting those loan puts as well. Instead of having to go and look at it, you could say, I'll, go ahead and put that order in for 20 cents to close those as well.
Once it's formed, yeah, immediately. Yeah.
Yeah.
I
Yeah.
like to have only long puts.
Mm-hmm.
Yeah. That way, if the S hits the fan, you know how hard it is to close a Black Swan hedge as a pair. So it's easy to sell puts out, but that's why I want to eliminate all my shorts if I can.
Yeah. Yeah. That's great, y'all. I love this.
Yeah.
Anyone got
I like-
any questions? And let's look at my positions here and let's make sure we've got here ES. So there's long term. So this one I can call group positions and call this BSH 2 shorts only or something, just to tell me that, hey, I got to get the loans on there. Uh-huh.
Yep. Yep.
And let's see if I've got my other Black Swan hedge. Yeah, here it is. So I've got a Black Swan hedge here. So I can go here and go close position, close all 12 of those when it gets to a price of 20 cents. And time in force, good till cancel. Review.
Bobby,
And
can I make a suggestion before you do that?
yeah, absolutely.
Why don't you go back to the position
Mm-hmm.
and I would place a long put vertical for the 12 for the same amount.
A long put vertical.
So buy 12 of the 2,700 and
Uh-huh.
sell 12 of the 2,650 for the same 20 cents.
Oh, that's interesting.
That's how I do it.
Let me think about it, Tony. I want you to rationalize it for me. Tell me the rationalization between that. I like that though, because you're
The
getting a
reason-
credit for the.
No, It's a debit, right? But
Yeah.
the reason why I like it is because I lived through a few crashes with black swan hedges on,
Mhm.
and in order to take units off, the computer doesn't like when you take off a long put, and the spread is going to be so wide. The bid and ask is going to be you live through COVID, right?
Yes.
So if you have only longs, you can peel out one or two little by little, and then you're left only with beautiful 8 naked longs. That's how I like to do it.
Well, look at this, Tony. It's already trading for 15 cents now. So
now we have to take into consideration the extra commissions on the other side in your Excel sheet.
mhm.
And if you break even or make a little money, of course, they should be gone.
Wow. Wow.
You see, I'm not only a pretty face.
You're not only a pretty face, Tony. This is amazing. So are you saying that I could really kind of take these off right now?
Yeah, we have to do the math to see if the commissions don't hurt you.
Let's see. That would increase my buying power. It's going to cost me $140.88.
Yeah.
But I could close the whole thing now at 20 cents.
Can we go to your Excel sheet to see if we're still at a credit or a break even?
Yeah. Let's see.
It's 141 bucks.
141 bucks. So we did really, this was $1,000 investment, right?
Right.
So,
but let's pretend it was it wasn't a credit, right?
Yeah, this was a debit because it was my first go at it.
Okay. It's still, I would take advantage of the rally and take it off.
Yeah, which would leave me with 8 long puts for 126 days.
That's beautiful, Bobby. Do it.
Isn't it though? I mean, I kind of like that.
Hit it,
hit it, baby, hit it, hit it, baby. Look at that. Now Big Bobby is left with 8 long puts.
How's that?
I like it.
Ain't that pretty? Yeah,
I like it, Tony. And I've started my next tranche of these things. So in other words, what Tony has said is that, hey, I have now taken advantage of these last few days of this, just huge up move.
right.
And I was able to harvest those things along with some of the longs, but now I'm left with 8 longs.
That's beautiful.
I like it.
I love it. I love it. I love it. I love it. That's the way I like to do it. I don't like to leave. I don't like to leave any children stranded. And I mean children by the naked puts out there.
Yeah. Okay. Anyone got any questions on that at all? That was kind of cool, right? So Coach says, for Black Swan Hedge, do you still sell the short put for $3, even though the market is much higher than when BSH was developed back several years ago? I think so.
Yeah. $3 is fine.
Yeah, I think $3 is fine.
I mean, you can use $4. It's not really a rule. You can use $4 as long as you're consistent. If you like 4, do 4. If you like 5, do 5. Geez, but I wouldn't do less than 3 because then the deltas are very, very, very small.
Very awesome.
And the other one, if you go to 60 days out, let's look at the 2 delta. How much is the first 2 delta? The first one, it's about let's say 470, right? We would buy one of those, and then let's take a look how much is the same 3,900 in 30 days. How much money?
3,900 in 30 days.
Right.
Is, let's say 32. 3,900 is $1.45.
Yeah, so we would lose $3 that we have to make up somewhere else, or just take it into consideration our trading plan as our insurance.
Wow.
Yep, that's the other way to do it. But this is paying for insurance every single month.
And I kind of like the way we're doing it because this way we're going, hey, you have an initial debit, but thereafter this thing should be done for a pretty much a break even.
Yeah. You know why, Bobby? Everybody that starts the black swan hedge becomes lazy and stops doing it. So
God, yeah, Tony, you're right. I'm a lazy slob. I stopped doing it.
yeah,
Why did I stop doing it?
everybody does it. Everybody does it.
And
So
Tony, I mean, look, here's the thing. I made 208% in my portfolio with the Black Swan hedge during COVID. Why would I ever stop that?
laziness,
Laziness,
complacency,
slothfulness, you fat black
complacency.
glass wearing slob, you Bobby.
No, because people think I don't need this crap. It's a lot of work. I don't want
It
to
is a
go
lot
to
of work.
It is a lot of work. It's too much. Like everything in life, working out is too much work. You know, doing your duties is too much work. Everything in life that it's worth doing, it's too much work. So let's get off our butts and do it.
Let's just do it, y'all.
Yeah.
God, Tony, you got me all fired up now. I'm ready.
Okay.
Hey, has
Now-
anybody got any questions of Tony at all? Anything that you'd like to ask him? Y'all can undo the mic and we'd love to have you.
Yeah, and don't sleep on the 2x loss. That's very important too.
Right. We got to take it, y'all. If the loss comes, we're just going to suck it up and we're going to say, hey, it's going to make us a few trades extra to make up
Yeah.
the loss, but we stay in business.
You're staying in the infinite game. That's the key.
The infinite game. And the infinite game, y'all, with this Black Swan hedge is now what was 3.5 is now a 3.8. Everybody
Yeah.
see that? I'm now short 3, long 8. So next time, after I get this one filled, I'm going to sell 6 of these.
Yeah.
And I'm going to keep building this thing up bigger and bigger and bigger.
Yeah. Yeah. You don't have to deal with the math of how many long and how many shorts I am, etc.
Yeah. I love it, Tony.
Good.
All right, guys,
Good.
everybody have a great rest of your day and have a great weekend. Tony, thanks for joining us. This has been a great session. Y'all, there will be no Muscadine Mafia session because this is it. This is the Muscadine Mafia group today. So y'all have a great day and a great weekend. Thanks, Tony.
And good luck trading, everyone. And remember, you got to risk it to get the biscuit.
Amen. I'm going to send you that PDF right now, Tony.
Thank you, my friend. Have a happy weekend with you and your family.
You too. Bye-bye.